Why is wallet hygiene important? And just taking a quick step back, what we're doing at Cryptio maintains and manages all the wallets within a company. So we see the good, we see the bad, but it's super important to have really strong wallet hygiene, and that's what we're going to get into here. Because it's not just a buzzword, it's really critical to security and compliance initiatives, overall financial reporting too. Proper digital wallet hygiene practices safeguard assets, protect sensitive data, and ensure smooth financial operations. So starting with security, one of the more important aspects, it helps with theft protection. Hackers and scammers, they're constantly on the prey for vulnerable crypto storage. Strong wallet hygiene practices like secure keys, multi-factor authentication, and regular just updates help minimize these risks. Reduce fraud risks as well. Implementing internal controls, transaction monitoring, and clear segregation of wallets also helps detect fraudulent activity. If you have commingled wallets, it's difficult to see a break in a trend, and we'll get into more of that later. And overall, just data protection. Sensitive private keys and seed phrases security become paramount to enterprise data protection. Wallet hygiene ensures these are never exposed and shared, and that they're securely maintained. Next, compliance. We know that the compliance needs, regulatory requirements could be very, very, very demanding. So maintaining a clear wallet infrastructure as the regulations evolve, whether it be tax or just reg reporting needs, companies need clean wallets and documented transactions to better be prepared for audits and just reporting requirements. Also, investor confidence. Without clean operations, without clear and concise actions for each wallet, your investors will just lose confidence. If your financial reporting takes, 20 days to get to month end, quarter end close, they're going to be wondering what's going on. And some of that might be because you don't fully understand, or you have to break down what's happening in a messy wallet infrastructure. Commingled wallets they can be a big problem. Having additional assets on your balance sheet, showing why you're paying expenses, how you're getting in revenues, it needs to be very transparent. You need to keep it clean. Financial reporting, you need clear business lines. You need to clearly identify the types of revenues, expenses, and asset balances by wallet and what they represent. If you're commingling wallets, it could be very messy to try to differentiate what's going on. This also brings operational efficiencies too. Organized wallets with clear labeling and categorization enables faster internal transactions and smoother inventory management. Also, tax reporting. I know at Cryptio, we usually recommend doing inventory management by wallet. What are your gains and losses? It's very clear and concise with proper record keeping and transaction history through wallet hygiene to simplify tax calculations and avoid just complicated issues. When being reviewed or when being asked questions, it's very clear, where your gains and losses are coming from. Also, improve transparency. This one's evident. I mean, you need to be crystal clear on what each wallet is doing, why it's being used, making sure that you're not commingling client funds with funds that are being used to pay expenses. This transparency will be key, and just making sure you build trust with your investors, your management, and just through audit processes. The other aspect too is scalability. We need to be able to scale comfortably. Now, when first starting off, when being a startup, you might say it's not a big deal. I understand everything going on. It's simple to maintain. But as the business grows, as transactions increase, it'll only become more and more difficult. So getting the proper wallet infrastructure now instead of later will be crucial to making sure that you could scale your operations effectively.
Yeah, Jeff, I like to, if you go back to the last slide real quick, I like to think about things in the TradFi lens to help me kind of relate to what's going on here in the Web3 world. And I think about how easy it is to just open or create a new wallet, right? Like I can just go out to MetaMask and create an infinite number of wallets. But in the TradFi world, it's not as easy to just go open up a new bank account, right? You have to go through a bunch of paperwork and all the due diligence that the bank wants to do as well. And so I think that's really a huge reason as to why this has become an issue, is because it's just so easy to create a bunch of wallets versus when you compare that to TradFi, you can't really open up a new bank account every day.
That's a good point. Just the ease of opening and getting a, too many wallets, could be a big problem.
Yeah. If you will go to the next slide though. So one thing that, like I mentioned earlier, I'm a visual person and I like to think through an example here. So let's walk through an example and maybe you guys can help me raise some red flags here as I talk through some of these different things. So you're a new CFO hired by Crypto ABC LLC. When you get in there, you learn that Crypto ABC LLC has 47 different wallets, 3 Bitcoin, 34 Ethereum, 7 Solana, and 3 Cosmos. There's no reconciliation process for reconciling the books to your wallets, or in other words, on-chain data. You have 0 internal controls over who has access to the wallets. Anyone and everybody can get access to them within your organization. There's no rhyme or reason why or when wallets are created. You guys can see maybe jumped ahead and foreshadowed a little bit here, and then number 5, there's no organization of key pairs or good records of wallets that have been created since company inception. So my red flags, my alarm bells are going off as I'm reading through these things as an example in this, as I'm a CFO in this example. So, number 1, I read through that and I'm thinking 47 different wallets. Why do I need so many? It could just be that, hey, the prior CFO would go in and create one because for who knows what reason. And then also, maybe the controller or the CEO or marketing or whoever else was going in and creating these wallets without any rhyme or reason. They had a need. They didn't want to wait on anyone else. And so they just went in there and did it on their own. To me, that's kind of a red flag. There should likely be a rhyme or reason why we're creating these wallets. And if there's already a wallet that's been created, let's say for paying payroll, there's no need to go in and create another one every 2 weeks or so often. We have one that's already there. It's got a defined purpose, so let's use it for that purpose. Now, really being able to reconcile the balances in your wallets back to your books and your financial statements as well. I mean, it's as simple as in the TradFi world, comparing it to a cash reconciliation, right? Making sure that the balances in the wallets reconcile back to what we have on the financial statements. Internal controls, I think this is a huge one. Jeff, I don't know about you, but since we work in this industry, I bet I get probably 10 spam emails every day to my work email trying to get me to click on, some bad link that's going to drain my wallets or whatever they're trying to do. And so really making sure that we've established those internal controls. And so, maybe some examples are, who has access over the key pairs, right? The private key and the public key, making sure that we're segregating duties. And so it's not just one person that has access, but we also don't want it to be open to the entire company as well. Maybe we limit it to 3 people. And if you're, doing MPC or multi-sig, making sure that you're really thinking about who has a part of that key pair.
And
Yeah, go ahead, Jeff.
On that point too, I think a lot of companies, every company's a startup at some point. I think a lot of them, they know the right things to do. It's just they're doing whatever it takes to get the job done. They might only have 3 people to start, and then they have 5, 10, and then things become a real issue where they're real risks, but they have no controls in place. So it's for a lot of these companies to really think about like future proofing where their company is now, even if it's only with 3 people, and identifying like the different stages of growth and documenting those, because internal controls are ignored far too often, especially with less mature companies. Sometimes they wait until they have an audit, on the calendar, and then they scramble to build all this stuff that they know auditors are going to be looking at. So it's thinking about it sooner rather than later.
Yeah, 100% agree. Thanks for that there, Jeff. We kind of talked through each of these there, but really just as Jeff mentioned, taking a step back and thinking through these as your company is scaling and making sure that there is a reason behind each wallet. And this in turn will give you better data. I mean, can you imagine maybe your CEO comes to you as a CFO and says, "Hey, we want to know, what our payroll expenses were in August," right? And you don't have those exact numbers because you're not keeping everything separate and you don't have good data. Jeff, you want to go to the next slide here?
Yeah, so we've identified a company that is extremely messy. They've opened up way too many wallets, limited controls. Now what do you do? How do we get to a state where we could have good wallet hygiene, and good operational infrastructure? So before we even talk about assessing the damage and how to clean it up, let's chat about the different type of wallets too. There's many different types of wallets that you could open. It could be cold, hot wallets. It could be even what we consider warm wallets. We'll talk about just the cold and hot wallets for now, and some of the benefits of using each of those. So with cold wallets, that's something that's maintained offline, where the private keys, where seed phrases are documented, nowhere online. It's very decentralized, and you reduce the risks of online hacks heavily. But it also opens the risk of losing that data, of losing your seed phrase. And there's benefits and risks of each aspect of these. Cold storage would be seen for less liquid options, where you want to use it more of a treasury, where you want to use it for less interactions with the company and kind of let it sit there. There are different providers though that have cold wallet options. I mean, you don't always have to have a ledger, which is like a personal storage. You could go with like a BitGo or a Coinbase, where they maintain a lot of this data for you. They'll implement like multi-signature wallets, where they're required to have multiple approvals for transactions and add layers of security and prevents unauthorized access. Talk about hot wallets. That's the MetaMask. That's the companies where all this data is living online. Fireblocks has multiple layers of wallets, where you could have hot, cold, and warm wallets, but it's understanding what these different wallets are being used for, and when you should set up each type. A hot wallet, for example, would be better when you have tons of transactions happening in any day, where you're making multiple payments or you're taking in multiple payments. But something like Fireblocks also has security measures. I think over time, we've seen the wallet infrastructure for companies increase, where previously there was limited options. Now you have a decent amount of options. So jumping into it, what do you have to do? First, you have to quantify the chaos. You have extremely messy infrastructure. You've opened way too many wallets, and you're using them for multiple different things. You're receiving payments, you're making payments out of the same wallets. So it's to go through, and this is where one time I would say spreadsheets are actually your friend, where I think in the world of crypto, you need to automate and create a system solution for the majority of it. But in this situation, document every wallet, what its purpose is, where the locations are, what's the type of wallet, what's it being used for, what's the transaction history, and use spreadsheets to clearly document this. Unless you lay it out all on paper, you won't understand where you need to go. You need to understand where you are right now, so you could clearly identify how to clean it up and fix it. So once you've identified all this mess, what the different wallets are being used for, whether it be accounts receivable, accounts payable, inventory, now you could break out and categorize and consolidate some of these functionalities. Group the wallets by functions, hot wallets for daily operations, cold storage for long-term holdings, like we mentioned before. Is it revenue? Is it a payment? Exactly what are these being used for? And sometimes, or in a lot of cases, you'll want to differentiate the different kinds of revenues or the different types of payments that you're making, and clearly identifying specific wallets for specific purposes. So you could, I would say, at a minimum, have 3 different wallets, but you're likely going to want to create a little more granularity just to add more transparency into what exactly is going on, so you could label each one of these wallets for its specific purpose. So you have clear record keeping systems between each wallet. So, I mean, it'll also vary company to company. It's not an easy solution in saying, here's how your wallet infrastructure should be set up. So I think every company needs to look at what is their infrastructure now, what is their business model now, and where do they see themselves growing in 2-3 years, where they could grow and create this infrastructure responsibly. I mean, once you identify the different use cases within the business, it'll be a little easier to put it all on paper and lay out your wallet infrastructure. What this will also help you do is understand the different clients that you're interacting with. If you're receiving payments from multiple different clients, it'll help you with some regulatory requirements. If you're receiving payments over $10,000, are you going to be required to report a Form 8300, which Nik will go through in a little bit. But it'll help you categorize where the payments are coming from and going to, and identifying your clients as well, which will be important from a regulatory standpoint. So once you've done all that, and once you've created and consolidated your wallet infrastructure, it's now moving the assets to represent exactly what those assets should be in each wallet, and eliminating wallets, getting rid of wallets that are duplicate efforts, or creating new wallets for added transparency. So once you've identified a sound wallet infrastructure, now what you want to look at is everything up to date? Am I using the best approach possible? We talked about cold storage, hot wallets. Are these wallets up to date? Are you using the best technology or the best solutions on the market? And if you're not, it gives you the chance to step back, at least do a security update, get the most recent version, or do your own research. Figure out what different companies are being the most innovative and going to protect your company and the assets that you hold the best. And in my opinion, the most important part is just standardized processes and documentation. So it's likely once you've got started, your company got started, you kind of had a wild west where any one of the 4 people at the company would open up a wallet. You'd all share responsibilities. But now as you go through this process of categorizing and consolidating wallets, you've already created different processes. You've already documented different aspects of your operations that need to be clearly stated. How are you going to open wallets? Who's going to open those wallets? What are the different controls? What are the different reviews and approvals that you're going to need to take to determine on opening or closing a wallet? And this is all creating very clear and concise policies and procedures that is just from beginning to end. How can you view all the risks in the company and the controls that you're going to identify to mitigate those risks? Also to ensure that everyone's on the same page, to ensure that everyone in your growing company, in operations, in accounting, in compliance, all know the policies and procedures that need to be followed to get you to a comfortable state.
Yeah,
So
Jeff,
once you have, so go on, Nick.
I was just gonna give you a break there so, one thing that I think about that you were talking about earlier in a TradFi example of hot wallet versus cold wallet, that's more like your checking account versus your savings account, right? And then, one thing that I think is important for me personally in my own, personal crypto use that I think, within the realm of this presentation is important is if you are using a hot wallet and you're connecting to, decentralized apps, making sure that when you're done with whatever you're using that decentralized app for the day, that you're going in and you're breaking that link, if you will, at the end of the day. That's where hot wallets really have their exposure. Think of it like a cookie on the internet. When you go back to that decentralized app in the future, it may automatically recognize your hot wallet. So then, that way you're not having to re-enter your private key or your password or whatever it is in that moment. It makes it easier, maybe a little bit faster, but it really puts your hot wallet at risk if you're leaving those connected to those decentralized apps on a regular basis, because if that decentralized app is compromised, then they could have access to the funds in your wallet. So just another form of risk management there.
Good point, Nick. And what all this leads to in cleaning everything up is ultimately how you're going to do your financial reporting. It'll just add transparency into the different accounts you're hitting within your chart of accounts and how you could easily automate that. And that's the key here. It's to take a lot of the manual work out. And by having a solid wallet infrastructure, you're helping automate and streamline a lot of the processes downstream. So you're consistently making the journal entries to where they need to go and how they need to be made.
Yep, couldn't agree more, Jeff. And all the accountants in the room right now are clapping and smiling because we're talking about this, but all the growth-minded people are like, man, I just really don't want to take the time to do all this. But I promise you, investing just a little bit of time on the front end to make sure that your data and your wallet hygiene is in good place will save you a ton of time on the back end whenever you go to prepare your financial statements, especially if you're going through an audit or hand over information for your tax return, things like that. I mean, it'll make your life easier, it'll make your accountant's life easier, and everyone will be happy. So on this next slide, there's a lot of ambiguity in reporting, and we have a lot of guidance that is clear as mud right now. And so let's talk through how that ambiguity may impact your wallet hygiene. So on the financial reporting side of it, if you're following US GAAP, right now FASB, our friends over at FASB, just recently released a new ASU 2023-08. If you want to Google that and have some light reading before you fall asleep tonight, you can go out there and do that. But basically, they did not specifically say the method of cost basis that you need to choose when you report your crypto assets on your financial statements. The only stipulation is that you just have to disclose which method you use. And so what am I referring to here? Well, there's specific ID, there's FIFO, there's HIFO, LIFO, all these different kinds of ways to identify your cost basis of your crypto assets. So that's FASB. IRS in the US has said we've gotten some interim guidance. It's not final, it's proposed, that basically says you're allowed to use specific ID, and in the absence of specific ID, then you basically have to use FIFO, first in, first out. And so if you've been using LIFO or HIFO in the past for tax purposes, now is probably a good opportunity to think about maybe switching over to specific ID or FIFO. So there's a difference in the two here, right? So if for book purposes you want to use HIFO, you're allowed to do that, and all you have to do is disclose that. But for tax purposes, we're expecting HIFO to not be an option. And so maybe now is an opportunity to say, okay, well, um, there are certain wallets that I know I'm going to be trading a lot in, right? Or there's going to be a ton of transactions, and maybe it's those hot wallets that Jeff talked about earlier. Making sure those are all contained to, maybe just a couple of different wallets. So it streamlines your tax reporting here when we're going to have to transition to specific ID and FIFO. And also making sure that you're working with a subledger or, some other software that can help you identify if you're going to report different for book and tax, right? Like can your subledger report both on the same transactions? So something to also keep in mind. And then second here on cost basis is this idea of universal versus wallet by wallet. And so, again, FASB did not provide any guidance here, and all you have to do is disclose what you're doing. Tax, on the other hand, the proposed guidance is, hey, we're going to make you guys do wallet by wallet in the future. Again, that's just proposed. It's not the final rule, but this is what we're expecting the final rule to be. And so what's the difference between the two? Well, let's say you have, going back to the original example, 40 different wallets, and you sold Ethereum out of wallet one, but then took the cost basis from that sale of Ethereum out of wallet number 7. It basically just universal aggregates all your transactions, and it kind of just it takes the cost basis from aggregating everything. Wallet by wallet says no, you sold it out of wallet number 1, so that's where the cost basis is going to be pulled out of on a either FIFO or specific ID basis. So again, something to keep in mind as you're thinking about your reporting obligations going forward. Another key event that happened again at the end of 2023 that the FASB provided guidance on was valuating your crypto assets on your balance sheet. And so before this ASU came out, all crypto assets were subject to impairment. I don't think that is a big surprise to probably a lot of people on this call. What maybe we weren't expecting in that guidance is that there are only some crypto assets now that can be reported at fair value. It's not all crypto assets. And so, I'm oversimplifying whenever I talk through this, but basically FASB said really only just your fungible tokens can be reported at fair value on your balance sheet. And on top of that, it can't be any tokens that basically have a right to an underlying asset. And so there's probably some ambiguity here, but some people interpret that as wrap tokens are also not able to be reported at fair value. And so, thinking about if you're going to be reporting these assets on your balance sheet and you have to disclose a roll forward footnote, it's probably going to make your life a lot easier if you're able to have wallet hygiene that separates those tokens out. So probably having a wallet specifically for just those tokens that are subject to impairment. So it helps with tracking and calculating that impairment expense that you have to record. And then, separate wallets for just those tokens that can be reported at fair value. So it's very easy then to go in there and record those on a regular basis. Any thoughts there, Jeff?
Yeah, back to your wallet by wallet and cost basis methodologies. I think we see more and more of our customers going to FIFO by wallet as a best practice. Some people might be wondering, what is everyone out there doing? I think FIFO by wallet is becoming an industry standard. I think it also raises not a red flag, but it raises a flag if your book and tax differ. It makes it makes anyone looking at your financials say, well, why? Why are you doing this? So I think a lot of times too, it's recommended whatever your book is, you should be using that for your tax as well. You don't need to, of course, but more transparent you are, the easier it is for your financial audits and whatnot. And easily by doing this by wallet, it'll be a lot more effective, a lot more transparent. And the other aspect of it as well is you could control the cost methodologies as well. You can control the gains or losses. If you have a treasury that you're not prepared to sell, it has super low cost, and you don't want to recognize the gains, you could segregate that. You don't need to recognize the gains for that. You could put all the activity into a high churn wallet where you could fully expect what your gains and losses are going to be. So by doing a wallet by wallet and having good wallet hygiene, you could foresee what your gains and losses will be on the month, on the quarter, where there's not any crazy surprises.
Yeah, some good advice there, Jeff, and definitely agree. FIFO wallet by wallet is probably the easiest method. It's not always the best when it comes to tax purposes. So just gotta think about both sides of that. But it's a good point there, Jeff.
Yep. Next page, kind of wrapping all this up. We talked about different aspects of making wallet hygiene and why it's important. We have the security, compliance, financial reporting, and also scalability. Now let's start benefiting from a clean wallet infrastructure. Starts with clear policies, procedures on wallet maintenance, the concise purpose of each wallet. You've built transparency, and transparency builds trust, as we used to say at BlockFi. You've built trust in investors, trust in management, and trust in auditors. And by documenting all this, you've added controls along wallet management to ensure that the risks are mitigated. Again, if risks are mitigated, it makes for happy management, happy investors, and happy auditors. You're now able to grow more responsibly. You could be more operationally efficient. You have a clear vision into what the purpose is of each wallet that you've opened and that you're maintaining. And ultimately, you're going to be able to scale your business more easily. It's just a clean infrastructure to grow with and to also build on. It's not to say that you can't grow the wallets that you have and have more purposes, but it's to also document the clear purpose of each wallet that you have. And all this just leads to trusted financial reporting. I mean, that's what all the controls and risk mitigation does within any company. It leads to clear, concise, and robust financial reporting.
Yep, absolutely. I come from a tax background, so I have a compliance mindset, and I think that there's also a play here from a compliance perspective as well when it comes to your wallet hygiene. Tax loss harvesting is a thing. Wash sale rules do not currently apply to crypto, and I feel pretty strongly about that. Otherwise, I don't think Congress would feel the need to introduce this as a proposed law in certain bills that have been introduced recently. Otherwise, why would we need to codify it in those bills? So because of that, you can buy and sell these crypto assets at basically any time and harvest those losses. And so if you have that wallet where you're holding on to some hefty losses, in a period where you may be experiencing some gains and other tokens, go ahead and sell those tokens with those losses, right? And that'll help offset those other gains that you may have. And then you can turn around and buy those tokens that you sold almost immediately. There may be some economic substance rules that you have to consider, but it's a good way to plan for taxes. And then A common misconception I see in the tax world is that every one of these transactions is capital gain or loss, which is not true. Some of these are ordinary, and unfortunately, you can't offset ordinary income with capital losses. It's typically limited to about $3,000 per year, and so we want to make sure that we're keeping those capital losses and ordinary income separate if we can in our wallet hygiene. So that way we have good records and we can see, okay, we're going to have X amount of capital losses in the year. Maybe there's some other capital gains that we know we're going to offset with those losses, but otherwise this gives you more transparency into what your tax obligations are going to look like during the year. And then we're gonna talk about this a little bit more in depth. And Jeff, after we talk through the next slide, I definitely want to get your input on this. But there was a little bit of a scare at the beginning of the year where we thought that digital assets that were received in excess of $10,000 were going to need to be reported on a Form 8300. IRS ultimately came out a couple weeks later and said, no, this is not required right now, but stay tuned, this will be required in the future. And so, there's some planning that you can do right now to get ahead of that curve. Same thing with Form 1099-DA. This is another form that we're expecting to be required in the future, where brokers are going to have to start reporting gross proceeds and sometimes the cost basis for transactions to their customers. If you're familiar with the 1099-B that we all probably received maybe one or so here in the last week or two that were due by February 15th, that summarizes your brokerage account, if you will. And so this is going to be very similar to digital assets. And so making sure that you have this data that you can report on these 1099s going forward, there's again some planning that you can do ahead. And so Jeff, if we go to the next slide, we'll talk a little bit more about the 8300. So I think, both of us believe that there's probably some data and some processes that you can implement now in anticipation of this being required in the future. But basically this Form 8300, if you receive a transaction of greater than $10,000 in crypto assets, then you're going to have to fill out this Form 8300. Now you might say, okay, well, I know a way around this. I'll only accept, $1,000 max, and they can pay me, 11 different times of $1,000 each. That's not really how it works. The IRS also requires you to aggregate all of those transactions if they happen within a 1-year time period. So there's the aggregation rules you have to look out for if it's all coming from the same payer. So let's say you receive $12,000 transaction. What you need to do then is within 15 days of receipt of that transaction, it's not a very long turnaround time. And you can't wait until 15 days after the end of the calendar year. No, it's 15 days after you receive that transaction. You should collect the taxpayer name, taxpayer address, the taxpayer identification number. So if it's an individual, their social security number. If it's a business, their EIN, and then details about the transaction. And if you don't currently have a KYC process, or you're not collecting W-9s, and this is something that you're going to have to start doing for these transactions. And as I just mentioned, the aggregation rules, you're going to want to have some sort of system in place to automate and flag where you're getting these transactions in aggregate over $10,000, or something that can alert you when you do receive a transaction greater than $10,000, so that you're in compliance, because there's a very short turnaround time here. Jeff?
I'd agree, Nick. There's definitely some panic. Luckily, we have some time. I don't know what that's going to mean once the Treasury comes out with better guidance, because what does a payment mean in crypto? Is that just receiving crypto in any way? Like on a Uniswap where you give them $100 and they give you $100 but in crypto. So what does that mean, and how are we going to actually, there's very clear and concise ways we could easily identify when this is needed, but I think there's a lot of clarification needed on a lot of other aspects. But again, I mean, all going back to the wallet hygiene, I think not just understanding what your wallet infrastructure is, but any wallets that you interact with. I think now it's going to be all the more important to understanding, what are those wallets as well? What are the companies? What are they doing when they're interacting with your wallets? And making sure that you clearly identify, when you're going to interact with specific companies. You could categorize different wallets that are collecting payments, specifically over $10,000. So if a certain wallet gets hit, then your operations team immediately knows they need to submit a Form 8300. But all things to think about, because there's tons of regulatory requirements coming up and that are already here that wallet hygiene will help with.
Yeah, I like how you circle it back to the wallet hygiene there, Jeff, too. And maybe even another example is, let's say, you have 10 different wallets. Well, can you narrow down to maybe just one or two wallets that you're providing the public address to, where, those are the only ones that that it's even possible that you could receive a $10,000 transaction. So that way you're not having to monitor all 10 of them. So just, try to think ahead and try to maybe think about how you can get ahead of this before we get the final guidance from the IRS.
Yeah, that's a good point, Nick. And there's other just global requirements too. There's regulations such as CSOP and DAC 8, which is, I think, going to come out in another year or two. But there's a lot of requirements. I would expect the regulatory reporting requirements around crypto is only going to get more stringent because, they don't want it to be the Wild West, and neither do we. But just making sure that, we're prepared infrastructurally to answer that, because it's not super simple when talking crypto. But we could be prepared for it and just thinking about all these things.